Hello and welcome to this module on order execution and validity. Okay, so what's execution and what's validity? Well, execution is instructions sent to the market about how an order should be traded. We're going to look shortly at a market order, which is simply where you transmit an order to the market and say, please fill this order as soon as you can at the best price available. Of course, there's always the risk there that you might not get a good price, so you can set a limit where you transmit your instructions to say, look, I want to buy or sell these shares only at a specified price or better than that. So a little bit more on those types of executions in a short while. Validity is really about when that order should or can be traded. So for example, you have a good till cancelled order, kind of self-explanatory here, but just you place a limit order in the market. I want to buy 500 shares at $10 or better, and that order will be valid until you go back to the market and cancel your order. So that order can sit in the market for a short while or a long while until it's cancelled. Contrast that with immediate or cancel. You fill my order in full immediately, or it's cancelled straight away. And a bit of a halfway house, a day order it's a variation on good till cancelled, but at the end of the trading day, if the order has not been fulfilled, then the order is cancelled. Now, a stop order will execute if a price reaches a specified level. So you might say, okay, I want a stop order, buy the shares when they hit $10. Okay, so the price might be $12 just now. You're interested in buying the share if it falls down to 10. As soon as that price hits 10, the order is executed. Now, there's no guarantee that you'll fulfill all of your shares at that price because the price might continue to fall or it might rise again. But as soon as the price hits $10, the order is now valid and it will be filled as if it was a market order. Okay, some terminology. When we have shares or any security, in fact, not just shares, there will be two prices quoted in the markets. There will be a bid price and an ask price. So a share might be trading at 200 to 202 cents. Okay, so $2 to $2.02. Now the dealers in the market will buy the shares at the bid. The bid price is always the lower and the ask price is always the higher. They'll sell at the ask price. That's from the dealer's point of view. So if you want to come along and buy a share, well, the dealer will sell the share to you at the ask price. That's the 202. If you want to sell a share, well, the dealer will buy it from you at the bid price. You always lose on the spread and the dealer always wins. And really, if the dealer is making lots of transactions, both buys and sells at the same time, then that spread, that difference between the 200 and 202 cents represents the dealer's profit margin. The best bid in the market is the highest bid price. Remember, this is the price at which the dealer sells. So the highest price is the one that's best for you as a market participant. The best offer would be the lowest ask. You'll see there that ask and offer are completely interchangeable terms. So the ask price is the offer price. The best bid and the best offer price from all of the dealers in the market, they're said to make the market, and those would be the market prices. And if you accept one of those offers or bids, then you are taking the market price. Okay, a bit more on market and limit orders as flagged earlier on. So a market order is one which is flagged for immediate execution at the best available price. So if your priority as a trader is to fill your trade quickly, and that might certainly be the case if you're trading based on information that you know and the market doesn't yet, then a market order is the one for you. Now, the risk is, of course, that you might execute at an unfavorable price. Okay, so if you're buying a share, the current market price is $10, you transmit your market order, you're happy with that, but before your trade can be fully filled, the price begins to creep upwards. Well, your order will continue to be executed until it is filled in full. If you want to avoid that risk of executing at an unfavorable price, then a limit order might appeal to you. So you'll set a price at which you're happy to buy or lower. You'll set a price at which you're happy to sell or higher. That avoids any uncertainty. You know that your trade will not be fulfilled at an unfavourable price to you. The problem you've got though is the price might never hit that limit and the order might not be filled in full or indeed at all. Now, a bit more variation. We saw some stop orders earlier on. So this is where the order is not valid until the share or the security hits the stop price. So you consider that stop price to be a trigger price. As soon as the security hits that price, the trade is now valid. So a few scenarios where this might be appealing to you. So if you own a stock, it's currently trading at 35, you want to limit your losses on that order. Okay, so if the share goes down to 34, 33, okay, well you're reasonably happy with that, but you don't want to incur any losses below 31.50. So a stop sell order would be one which only triggers when the share hits 31.50, and to limit any further losses beyond that point, the stop order would become valid and it would execute at 31.50, or at least it would become valid when the share hits 31.50. The share may plummet before you're able to execute the order in full, but in principle that would limit your losses. If you're short a stock, and remember with a short position you lose as the price rises, so just looking at it the other way, if the share is currently trading at 35, you will lose if that price rises. Your stop buy order closing out your short position kicks in at 39. So once the share hits 39, you've got a loss of 4 from the current price. That's when you buy, you close out your short position. Again, the idea is to limit your losses. Now, stop orders not only useful to limit losses. Okay, so for example, you might think that once a price hits 60, that might be a kind of barrier price. If it hits 60, you expect it to make a strong upward move ahead of that. So you're interested in buying once the share price hits 60, if it's currently below that. So a stop buy order would be one which kicks in when the share price hits 60. Hopefully you'll buy most of those shares at 60 or very close to it, and you can profit from the strong upward move that you expect after that. Okay. Here's a worked example on some execution and validity parameters. So you've got an investor, they own shares in Acme. They're currently priced at $40. And, well, they're worried. Okay, they're worried about making losses. And they want to limit their losses beyond a loss of 10%. So they want to sell their shares only if the price decreases by 10% or more. So what type of order would be the best course for this investor? Well, I think we're going to be looking at a stop sell order. So 10% below 40 would be 36. So a stop sell order at $36 will only execute if the price hits 36. Okay, so if the price stays above 36, these shares won't be sold. Now the price might go down, it might go up. So what the investor may do is implement a trailing 10% stop and just rebalance or reset that order. Let's say the price doesn't go down at all, instead it goes up. It goes up to 42. So they still want to limit losses beyond 10%, but beyond this new higher price. So 10% of 42 is $4.20. Take that off your 42, your 10% fall now goes in at 37.80. So you can increase your stop limit from 36 up to 37.80. And again, you're limiting your losses beyond 10%. Okay, just a bit of a distinction now between primary and secondary markets, which we touched on in previous modules. The primary capital markets, the primary stock markets, are concerned with the shares of new issues of stocks and bonds. Okay, so these are securities that did not exist before. If a company has not listed in the stock market, if their shares and bonds were not available for public purchase beforehand, then they will indulge in an IPO, an initial public offering. So the company simply wasn't listed in the past. But even an existing listed company will still use the primary capital markets to issue further shares and bonds, and those are known as seasoned offerings. The company, the issuer, receives the proceeds of those new issues minus any fees, underwriting fees that they have to pay to any investment bank or advisor. Now, the secondary capital markets, and I must admit, when I think about the stock market, this is what I visualize in my head. These are securities which already exist and they're being bought and sold by market participants. It's where the securities trade after their initial offerings. So you think the New York Stock Exchange, the Nasdaq, the LSE in London, other over-the-counter venues, shares currently in issue, current owners want to sell them to new buyers. Now, the secondary market provides liquidity. So if you own some shares, you know that you can go and sell your shares, you can liquidate your investment reasonably easily. And also, the more liquidity there is, the more buying and selling there is on the market, the more accurate the price is likely to be. So it provides information about the true value of the security to investors. A few different types of offering that can be undertaken in the primary market. So an underwritten offer, hinted on it on the previous slide. An underwritten offer is where an advisor to the issuer, usually an investment bank, they guarantee that all of the shares the company wants to issue will be sold. So they guarantee it. So if there's 1 million shares on offer in the IPO, only 800,000 are actually subscribed for by investors, then the investment bank guarantees to take the other 200,000. A best efforts offer is where the investment bank simply acts as a broker. It acts as an introduction agent to investors. It does not guarantee the security sale. So with a best efforts offer, there's no guarantee that the company will raise all of the finance they wanted to. Now, a private placement can take place off the exchanges. In fact, it does take place off the exchanges. It's where a company simply issues new shares directly to qualified investors. A shelf registration is where those securities are not all issued at once, but instead they are drip fed into the market, drip fed to investors over a period of time. And a dividend reinvestment plan, again, new shares are being issued. We're in the primary markets after all, but they're being issued to existing shareholders, usually at a slight discount. So instead of receiving a cash dividend, the shareholders can opt to subscribe for those new shares at a slight discount. And that's quite similar to a rights offering, but this isn't in place of dividends. It's simply where the company offers new shares to their current shareholders in proportion to their existing shareholding. Okay, some more different types of market structures here. A quotes-driven market is where investors trade with dealers. Okay, there's a middleman, a market maker, is what the dealers will be acting as here. Usually this takes place in less liquid markets where there's not quite as much demand for the shares or the bonds. So there needs to be a dealer who take an inventory of these securities and they'll trade directly with investors. An order-driven market is where the buyers and sellers are anonymous, and this happens in more liquid scenarios where there's enough demand for particular securities that you don't need a dealer making a market. Instead, those buy and sell orders are placed directly on the exchanges, and they are matched. Buyers and sellers are matched automatically according to pre-specified rules. A brokered market is where an order comes in, an investor makes a buy or a sell order, they place it with a broker, and they go and find a counterparty for the trade. But brokers and dealers are not the same thing. Dealers will keep an inventory of shares and deal directly with the buyers or deal directly with the sellers, whereas brokers don't hold an inventory. They act as a pure introduction agent. They'll find counterparties for the traders to trade with. Now, call markets are markets where the securities trade only at specified times. So at specified times during the day, bid offers and sell offers they're asked for, they're accumulated, and then via negotiation, a price is set which clears the market. Okay, the price is set at which those trades will happen. It's used in smaller markets with less liquidity and also to use as an opening auction for major markets in order to set the opening price. Contrast call markets with continuous markets, and those trades will occur at any time the market's open, either via an auction or by trading directly with dealers who are offering bid and ask quotes. And those dealers, those market makers, they're obliged to offer bid and ask quotes at all times that the market is open. The features of a well-functioning financial system are as follows. So a complete financial system is one where all assets and contracts are available. Basically, it allows investors to achieve their purposes. A complete financial system will allow investors to achieve their aims. An operationally efficient system is one where transaction costs are kept as low as possible. And an informationally efficient system, it's going back to the efficient market hypothesis, is where the prices reflect or closely reflect the true, the fundamental, the intrinsic value of the share. So again, the more liquid the market, the more informationally efficient that market will be. To achieve these elements of a well-functioning financial system, financial intermediaries like brokers, dealers, investment banks exist to facilitate transactions in less liquid markets. Of course, markets are regulated, and they're not regulated for the sake of it. They're regulated for specific purposes. So the regulations exist to protect unsophisticated investors. It sounds like quite a nasty way of putting it, but really all we mean here is that your retail investors, the general public, who've got better things to do than to understand the ins and outs of the financial system, those regulations are there to protect them from being taken advantage of. The regulations also require minimum standards of competence. Part of that will be measuring performance of securities and investments accurately. Of course, inside information is illegal, so although in many cases it is possible to trade on informational advantage, that has to be done fairly. Inside information is a crime in most jurisdictions, so regulations exist to make that so. Ideally, the companies that are traded on the markets will have common financial reporting standards. This is important for comparability. So when investors are deciding which securities to buy, the one obvious source of information would be the financial statements of those companies. But unless those statements are produced using similar reporting standards, then it's very hard to compare like with like. Finally here, the final objective of market regulation is the markets, depending on what market you're in, will require various different levels of capital. The idea there is that participants can be confident that the people they're trading with can honour their commitments.